But that being said, there's also a great opportunity right now for Roth conversions.
Yeah.
That's a conversation we're having a lot of.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, president and founder of TJ Stearns Inc. Tim, always a pleasure every time we get the opportunity to connect. For Americans across the country, I don't even know if there's a category. It's almost all of us. It is crunch time. We are getting into the thick of tax season, and I'm sure that is a lot of the conversations around the office there at TJ Stearns.
Right. I mean, one of the things we always talk about is saying we have people come in here, shoulda, coulda, woulda. I think even CPAs do that on April 15th. So we are always trying to, harp on the fact that people should be, thinking ahead for taxes, not thinking of them just this month leading into April 15th, right? We're talking about
Right.
getting on it so that you're making sure that you know exactly what you could be doing to, not cut corners, but mitigate your taxes, so that you're, working in the black and white, but you're also, cutting down on your tax bill.
Well, shoulda, coulda, woulda. I think there's a large wave of generation here that for the last 30, 35 years, Tim, is sort of looking back at the taxes that they deferred and delayed on their retirement savings. And I hear it a lot. Like, I wish I would have done more in Roth. It was not a mistake. And I think I want to emphasize that point with you and clarify and confirm that that is the case. But I don't feel that it's ever a mistake to save as much as possible for retirement, nor to do it in those tax deferred accounts over the last 35, 40 years. It's just maybe now's the time to change our way of thinking and our tax management approach, right?
Okay, so if you're saying that, people are still working, I would tell them right now, while taxes are, artificially low, do the Roth. I mean, we at least know we have it till the end of the year. These lower tax rates. President Trump has tried to extend them. We'll see where that goes. But that being said, if you are also out there and you've created this huge tax time bomb, we'll call it, you know, yes, you planned for a rainy day. Yes, taxes are going to be, involved here. But at the end of the day, you at least have money.
Right.
I mean, we see people, that have come to our classes and our workshops that are living Social Security check to the next one. So yeah, I think congrats that they saved the money. Yes, it's going to be taxable, but at least they have it.
Well, but also like taxes have come down over the last 30, 35 years. So like those dollars that we saved back in the late 80s as we began our career, we started these 401ks, Tim, like we are probably paying less taxes on them today and all of the little baby dollars they created since then, right?
Exactly. I mean, the tax deferral, you can't beat that, right? So, but that being said, there's also a great opportunity right now for Roth conversions.
Yeah.
That's a conversation we're having a lot of. People are worried about, well, what if it pushes me up? It's going to subject me to IRMA. If it pushes me up into a different tax bracket. Well, if you're 65, chances are you're going to live to be 85, 90 years old. Why not pay the taxes right now? We've all talked about the taxes are going to go up. One thing I always see in my workshops or my classes is I ask two questions. Number one, do you think taxes will go up in your retirement? Everyone gives me a thumbs up.
Yes.
I
Yeah,
ask them if
absolutely.
healthcare costs are going to go up, and they give me a thumbs up. That's one thing I've never had anyone disagree with me on. So that's why it's important to at least address this 800-pound gorilla, maybe 1,000-pound gorilla in the room called taxes. So at least nibbling on that tax bill is not the worst idea.
Right. And again, not a mistake to have saved anything for yourself. And we took advantage of the opportunities that we had available because the Roth hasn't even been around for as long as the traditional 401k. So that's the way a lot of people started. A lot of people didn't hear about the Roth until even further after it was actually incepted and around. A lot of companies did not adopt a 401k in their Roth. So no matter where you're at, like don't kick yourself for having saved. It's just that now is the time, and time being of the essence, now is the time to go ahead and proactively address that tax bill and manage that tax bill. And that's a big part of the conversation there at TJ Stearns Inc. with Tim Stearns CFP, helping you to keep more of your money. You worked hard for it. It worked hard for you over the years. It grew, but so did that tax bill. And so that's why we want to manage the taxes. It is one of our biggest tax opportunities. As we are talking about tax filing season, let's go ahead and have a forward-looking, proactive conversation and implement that proactive approach to minimizing and controlling that tax bill. And Tim Stearns can help you with that. Pick up the phone, give him a call. 800-640-2256, 800-640-2256. You can also go online to the Retirement Tax Bill Calculator, mvpcfp.com, mvpcfp.com. You can run and crunch your own numbers. You can input them there. But again, if you would like to have that conversation or just hear what the bill is likely to be on your retirement balance and what you could potentially bring it down to, and then trust the professionals to help you execute in managing that bill, give a call to TJ Stearns at 800-640-2256. That's 800-640-2256. So, Tim, I mean, we all, if we earned any income, I guess there is a small percentage that doesn't have income, that doesn't need to file, but we all pretty much need to file. What should we be doing before we file? And are there any last minute opportunities that you help your clients identify?
Well, if we have new clients, we will ask them, have you done an IRA or a Roth for the previous year? Because right now you can double up until April 15th. So that is an opportunity. Then we also ask them about their children. Did your kids have earned income? Can they do a Roth? Can you afford that? I know with my kids before they, got into the real world, my wife and I would always make sure that that we contributed whatever we could to their Roths, because that's money that's going to grow for hopefully another 50 years or so. So great opportunities. One thing I want to bring up though, that I'm seeing a lot of, people are coming to us because they're not real happy with their current advisor, because they're seeing their advisors as being only a money manager, and they're not helping them with taxes. I've seen many big box firms that you see on TV won't even advise people about their taxes. We have a CPA on staff. I think that puts us above others, that we're not afraid to tackle that issue. And why would you want to pay more on taxes? So if you are just dealing with a money manager out there and you're wondering, well, how could I legally start to pay less taxes, whether it's now or in retirement, give us a call. My book lends itself to this credo that we should be able to, legally minimize taxes. So for the first 10 callers out there that have over $1 million, give us a call. We'll get the book into their hands. And then we can also have a conversation about how to legally pay less taxes.
Can we throw in that tax report as well, Tim? The
That's a
retirement
great
tax bill
call.
calculator?
Yeah. Yes, of course. I would love to do that.
All right. So, ladies and gentlemen, if that's you, and if you've got over $1 million, remember that ignoring the eventual tax implications, the more that you have and the higher your income, the higher your investment value, the costlier and oversight it is to continue ignoring this issue, the more it is going to eventually cost you. So pick up the phone, give a call, talk with Tim Stearns, CFP, and enlist the services of the team from TJ Stearns, and get that complimentary book. It is a great guide on solving the modern retirement riddle. The title of the book, fantastic read. You get the Protect and Grow written plan. You get the retirement tax bill calculator, all with just a call here, 800-640-2256. That's 800-640-2256. 800-640-2256. Tim, the distinction you mentioned there with you're talking to people who are saying, hey, I've been dealing with just a money manager and not really a retirement planner. Like, I think that there is a time and a place for a money manager.
Sure.
right? I mean,
And
they
those is
provide
great.
a useful outlet for our dollars to get invested at a certain point in our life. But I also think that that transitions into the need for a plan, bringing more of the pieces of the puzzle and the picture together at a certain point in time. And that's where really you meet people, correct?
Right. We're, our sweet spot is to meet someone who wants to retire, wants to have a plan, is tired of just having a money manager. A lot of people are coming in here without doing, any tax planning whatsoever for their retirement, or worse yet, estate planning. And there's so many different things, that probate can really eat up time and money. And that's another thing that we are making sure people, checking the boxes. So when you come in to get a protect and grow blueprint, we're covering A to Z what needs to be covered during your retirement and your golden years.
Are there any other big hints, Tim, that you would tell people to sort of look out for that would identify if they are dealing with just a money manager versus a true planner or getting a plan put together? Like, what are the indications to me to look out for?
Well, one of the things that we are big on is blind spots. The different things that people aren't realizing that the Secure Act went through and what that will do to their money if they want to leave it to their kids and that type of thing, that it has to be drained within 10 years. It's amazing to me that most of the public isn't really up to snuff on that, knowing exactly what that did to retirement plans when you are not here anymore. So, the other thing we're seeing is a lot of old school lawyers in the area have told people to leave their IRAs to a trust, and that can become income in respect to the decedent, and then that's all taxable to the estate. So we're having deep conversations with people. We have an estate attorney here. We have a CPA. Those are the blind spots that we're seeing that we need to address.
So estate planning and interweaving, tax planning and coordination, those things oftentimes kind of left out of the conversation, left off of the table if we are strictly dealing with a money manager rather than a true planner for our financial future.
Absolutely. And if you're dealing with one of the big boxes that lets you do your 401k and that type of thing on your own, they're not going to touch that with a 10-foot pole. So we are happy to sit down with somebody to see if there's a fit on our end and on their end to see if we can help them. Because I do think the stones being unchurned are good for everybody.
What about Social Security or other retirement income generation and withdrawals and distributions, Tim? Do you see money managers dealing with that part of our financial picture?
Absolutely not. They will not touch that either. We do. We have a gentleman here that's, certified for Social Security and Medicare, that I have meet with even my siblings. And so that helps for the fact that we want to make sure that people understand, if you turn on your Social Security early, that could affect your spouse adversely. Or maybe you wait till your full retirement age, or maybe you even wait till age 70, depending on what your situation is. We're seeing people, "Oh, I'm going to take it at age 62." Well, that's fine, but what is that going to do to the rest of, your plan? And they don't have one, is what I see. And so they're just, it's my money. I want to go get it now. That's great. But let's, you know, really piece it out and make a plan as to why you shouldn't or should do that.
Yeah. Taking the Social Security blindly or telling you to take it without actually bringing that into the picture as part of the plan to see how that impacts and affects the assets and the longevity. That's a sign maybe you're just dealing with a money manager. Telling you that for retirement income, you'll just take the growth off the top, right? Like sounds super simple. And it probably is, Tim, when there is growth, but when there is a downturn in the market, how is that going to work out? And that's really where the rubber meets the road to know if you have a plan or not.
Right. How much powder do you have to keep dry in a market that's like 2000, 2001, 2002? I'm not trying to be a guy that's going to scare everyone, but guess what? The market does go down,
Hmm.
and you need to be alert to that fact. So when we're doing a plan for people, a lot of times we might put in an annuity, and the annuity gives them guaranteed income when those circumstances happen. When the market's up like it's been basically the last, let's call it 15 years, it's great. I'm happy for everyone, but at the end of the day, all good things must come to an end. And, 2022 was an anomaly, right? Where it bounced back the next year, thank God. But, we've talked about the concept of the lost decade, which was 2000 through 2010. And I just want to, jog people's memories that the market does sometimes not work on our behalf. It actually would work against us. So having a plan is crucial.
Well, again, if you would like to get that plan put together, in fact, if you would like the specific written protect and grow retirement blueprint designed and customized specifically for you in your situation, pick up the phone, give a call to certified financial planning professional Tim Stearns, CFP, there at TJ Stearns Inc. He does that on a no cost, complimentary basis, no obligation. Get a plan put together. Have that plan in your hands. The Protect and Grow Written Retirement Blueprint, 800-640-2256. That's 800-640-2256. And for the first 10 callers today with over $1 million, Tim Stearns offered the book, Solving the Modern Retirement Riddle. I twisted his arm, and he also threw in there the retirement tax bill calculator report for you so you know how much in taxes you are going to ultimately pay on your retirement assets. So again, the number 800-640-2256, 800-640-2256. Tim, back to the comment of being, or the conversation rather, of being within the tax season. You often make a comment that I find very intriguing, that most people you talk to can tell you within a very close proximity how much the balance of their retirement accounts are, but very few people can tell you with any kind of accuracy how much they will end up paying in taxes on those retirement accounts over their lifetime or throughout retirement. Not knowing that is kind of a scary fact. That might be another indicator of whether or not you're dealing with a true planner.
Yes, I agree with you. It is amazing when I ask people that in class or our workshops, they literally get, deer in the headlight look on their face.
A little starry
And
eyed. Yeah.
right. And the other day, on WGN TV, I went on there and I talked about the three biggest expenses. Number one is your taxes. And people have not done the homework on that to know exactly if you have, let's say, $2 million in your 401k, how much of that is going to be yours ultimately, that you can, take with you. So these are things that we're having conversations with people because I have a nickel every time people come in here and go, oh, I asked my other advisor and he won't do that for me. Well, what are you getting as a money manager? The market goes up, you go up, the market goes down, it goes down, but they're not really helping you get through your 35, 40-year plus retirement, and that's happening nowadays. I see a lot of people retiring at the age of 60 and their parents live to 90 plus. What are the chances?
Yeah.
So you need to have a plan to make sure you're not having to go back to work when you're 80 years old.
Absolutely. Well, again, ladies and gentlemen, jump on that opportunity. The book, the Retirement Tax Bill Calculator Report, the complimentary design of your custom plan, your written retirement blueprint, the Protect and Grow blueprint. 800-640-2256. That's 800-640-2256. Tim, I feel like we haven't even really touched what you prepared for the subject matter today. It often happens and it's okay. But kind of back to, we are in the heat of tax filing
Yes.
season. People need to decide, or maybe it's an easy decision once you crunch the numbers, but I think a lot of people aren't sure whether or not they're going to take the standard deduction or if they're going to itemize. And
Yeah.
by the way, don't forget your senior bonus if you're over 65, right?
Right. I mean, I always tell people, either use TurboTax or something like that if you're pretty simplistic. But if you have a lot of moving parts, get a CPA because they might be able to point out something to you that is going to, aid you in getting money back or not paying as much in taxes. We had one person about 10 years ago that was proud as can be that they were going to do their own taxes, and they ended up costing themselves $10,000. So, I mean, to pay even H&R Block says that they'll, stand behind you if God forbid you get audited or that type of thing, or they make a mistake. Another set of eyes never hurts.
Yeah.
And those are the things that we tell people if they don't want to use a true CPA on our staff.
Well, the standard deduction is pretty high, so
Yep.
that's where most people fall. But
Yes.
mortgage interest, state and local taxes, charitable contributions, and we know in the Chicagoland area that SALT tax, we've heard a lot about it, the state and local tax. A lot of people hit that upper limit where it caps out at that 10K. They're talking about lifting that again, but a lot of people, just because of those limitations, Tim, may otherwise itemize, but they end up with just the standard deduction, and this impacts ultimately paying more in tax than our fair share or what we ought to be paying.
Right. It affects the bottom line. And, that's why, again, we are trying to make sure that we turn over every rock to make sure our clients get, the tax deductions that they should, whether it's itemizing or what have you. But I mean, there are different ways to get ahead of this, putting more money in your 401k during the year, to mitigate taxes or, if again, you want to, take advantage of the low tax rates right now, the Roth. Profit sharing still goes on just the way you had it planned, so that's not a big deal. I think a lot of people think, well, if I do the Roth, I can't do this, that, or the other thing. It's the same program, but we can, I have clients call us all the time. Will you look at my 401k and help me? And we're happy to do that
Yeah.
because I mean they are clients. So I don't want them to make mistakes that I've seen other people do.
Well, we talked, Tim, about kind of last minute opportunities.
Yep.
Yes, you can still make certain contributions
Yep.
for last year, but ultimately that is historical, right? Last year has already passed. So as you
Yep.
are helping people formulate their plan, you're also looking at what adjustments they can make for the current year and next year,
Yep.
such as, did they get a whole lot back? Did they have to pay a whole lot? Is this a pain point? Is this something that you want to make adjustments to? There are steps that you can take. You and your team can show people how to adjust the withholdings, maybe how to make additional 401k contributions, whether traditional or Roth makes more sense. All of those things for the current year and the tax season ahead. Those don't necessarily affect what happened last year, but that will kind of right size people moving forward. But ultimately, you're not just adjusting for this year or next year. Tim, you're helping people make large scale shifts to help be more efficient with future taxes for years and decades into the future.
Right. One of the things that we ask clients, are you tax diversified? The taxes that you're paying year in and year out, taxes that are deferred, like in 401ks, and then of course tax free, tax deferred, tax free, like Roths, life insurance with long-term care benefits inside of them. Those, make sure you're tax diversified. You shouldn't be all in one area. Everyone knows that, just like your portfolio shouldn't be all in large cap equities, for example. So there's a lot of potential for tax-free vehicles out there that would also mitigate taxes.
And Tim, if we are in the situation where it is a goal or we are fairly confident that we are going to leave a legacy behind, I know that you spend some time helping clients and investors
Sure.
understand that there are certain assets that are more efficient and effective to be left behind than others.
Well, one of the ones that we've talked about a lot in our workshops is the QLAC, a qualified longevity annuity contract, that people can actually take money, put it in there at around their age 73, because that's when we have to start taking required minimum distributions. And right now it's indexed for 2025 that you could actually put $210,000 into a QLAC and it would grow and you would not have to take a required minimum distribution from that IRA portion because it's in the QLAC till your age 85. That really tweaks a lot of people's interests, and that's something that a lot of advisors have not talked to them about. So why would you not want to try at least look at that?
And in the meantime, Tim, like when RMDs would have started at 73, with what we didn't put in that, maybe we can do some other efficient kind of planning, right? And look at the assets that we have. But I know it's not a goal for everyone to leave behind a great deal of wealth. Like a lot of people listening are like, hey, it's not my intention to leave my kids
Right.
rich and wealthy. I don't
Yeah.
think that that is a selfish notion at all. But I also kind of am cognizant to the fact, Tim, that if we have planned for our own confident, lasting self sufficiency, then more than likely something is going to be left behind. So why not plan for that to happen efficiently as well, right?
Well, I mean, we've seen the required minimum distribution rescue, where we take the required minimum distribution, put it into a life insurance policy that they could, leave a legacy, or it could help pay with estate taxes if that's something that people have out there. There's different ways to, look at it, but I mean, we've done that quite a bit. Required minimum distribution rescue, where and then you're also in most of those plans getting a long-term care benefits inside of there.
Yeah. So again, way to leverage, way to be efficient, way to do more with less, and the money is valuable. The time that you can save, and understanding that you've got a resource, a trusted, experienced, qualified professional that can walk you through all of this, that has seen it before. The investment of time, therefore, from you minimized in getting a true plan put together. That is worth the time in and of itself, ladies and gentlemen. Not to mention the improvement that you'll have in your financial forecast and outlook as a result of having a plan in place, and the confidence that you have financially. So pick up the phone, give a call to your certified financial planning professional, Tim Stearns, CFP, Chicagoland's planning resource there at TJ Stearns, for that Protect and Grow written retirement blueprint. 800-640-2256. That's 800-640-2256. 800-640-2256 is the number to call. Before we wrap this up, Tim, one of the points that you wanted to mention is that the tax opportunities that we have today, they are not guaranteed to be around forever. Like, these can be, and in certain cases likely are, limited time available opportunities. So if you want to be as efficient as possible, the time to act is now.
We know what taxes are today and the programs that we can do in 2025. Give us a call and we'll shed the light on those ones that would be perfect for you.
Well, we are facing tax deadlines. Many savers and investors want to keep as much of their money as possible. But more importantly, ladies and gentlemen, the tax code can and likely will change. And we are at a point in time where we've got opportunities to keep more of our money, to control that tax bill on a lasting basis. And that's what you are encouraged to take advantage of, to really reflect on and see how you could benefit from some proactive planning. Tim Stearns, CFP, is here, the team behind him at TJ Stearns Inc., on standby to hear from you and help you formulate your Protect and Grow written retirement income plan. Give a call, 800-640-2256. That's 800-640-2256. Tim, we always appreciate the time, always helpful, encouraging reminders of the topics that we need to be addressing in our planning. And I love the fact that you and your team are there as a resource for so many.
Thanks, Peter, for having me.
Tune into Chicagoland's certified financial planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Investment advisory services offered through Cornerstone Securities, LLC. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.